between the famous Great Depression of the 1930s and the 2008 financial crisis. America experienced a series of forgotten financial disasters that quietly reshaped the nation's economy, politics, and daily life. Today, we're going back in time to explore 5 major but often overlooked financial crises and how they changed America forever. 1. The Panic of 1837. It all began in the spring of May 1837. The United States was experiencing a period of economic growth, fueled by speculative lending and massive land investments. Banks across the country were issuing paper money without holding enough gold and silver to back it. But by May 10, 1837, everything came crashing down. In New York City, banks suddenly stopped making specie payments, meaning people couldn't exchange their paper money for hard currency. The shock was immediate. Businesses began to collapse. Farmers who had taken out loans to buy land lost everything. Unemployment in major cities soared. Throughout 1837 to 1843, the nation sank into one of the longest economic downturns in its early history. This panic not only wiped out personal savings, but also changed how Americans thought about paper currency. It revealed how fragile the banking system truly was in the 19th century. 2. The Panic of 1873. Fast forward to September 18, 1873. At the center of this storm was the banking firm J. Cook & Company, one of the most powerful financial institutions of its time. The company had invested heavily in railroad construction, the symbol of American progress. But the investments were too ambitious. When railroad profits failed to match expectations, the firm collapsed. News of the failure spread like wildfire, triggering a wave of panic across Wall Street. Banks closed their doors. By September 20th, the New York Stock Exchange was forced to shut down for 10 full days, an unprecedented move. Businesses struggled to survive. Unemployment skyrocketed, and what began as a panic turned into a 5-year depression, lasting until 1879. The Panic of 1873 became known as the Great Depression of the 19th century, long before the 1930s. 3. The Panic of 1893. Just 20 years later, on May 5, 1893, another financial storm hit. This time, it was caused by overbuilding of railroads and weak banking institutions. As major railroad companies went bankrupt, the panic spread rapidly through financial markets. More than 500 banks failed. 15,000 businesses closed their doors. By the summer of 1894, unemployment had reached nearly 20% in some cities. Angry workers organized marches and protests. One of the most famous was Coxey's Army, which marched on Washington, D.C. in 1894, demanding government jobs programs. This crisis highlighted the dangers of speculative investment and a lack of federal financial oversight, something America would not properly address until decades later. For the Depression of 1922-1921. Now let's move to January 1920, a time often romanticized as the beginning of the Roaring Twenties. But before the party started, there was pain. The United States had just come out of World War I when the war ended in 1918. The government slashed spending, factories cut production, and millions of soldiers returned home looking for work. In January 1920, inflation soared and businesses began laying off workers. Within months, the economy shrank nearly 10%. Industrial production fell by 30%. The unemployment rate jumped from 4% to almost 12% in less than a year. By July 1921, the country was in a deep, sharp recession. Although this depression was short compared to others, it was brutal. Factories shut down. Farmers lost their land. It forced the government and private sector to rethink how quickly an economy can change after war. 5. The recession of 1953. Our final stop is July 1953. The Korean War had just ended, and the U.S. economy was transitioning from a wartime footing to peacetime production. During the war, defense spending had driven massive growth. But once it ended, government spending slowed dramatically. Companies that had been producing military equipment were forced to cut jobs. Between July 1953 and May 1954, the economy contracted and unemployment rose to 6%. a sharp jump at the time. While it wasn't as devastating as earlier crises, this recession reminded policymakers how vulnerable even a strong economy can be to sudden shifts in spending, a legacy that shaped the future. Each of these forgotten crises, to 1837, 1873, 1893, 1920, 221, and 1953 left lasting marks on America's financial system. They exposed weaknesses in banking, revealed the dangers of speculation, and pushed the government toward creating stronger financial institutions, including eventually. Even though they may not be as famous as the Great Depression or the 2008 crash, these 5 events laid the foundation for modern economic policy and shaped how Americans think about money, stability, and trust in their financial system. They are the quiet storms that built the modern economy, and they deserve to be remembered.